Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial. If you like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And while on my website, don't forget to click on the podcast page to check out our past shows and also to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Okay, so when it comes to building wealth, risk isn't just unavoidable. In fact, it's essential. Without it, your money can't grow. But too much risk can derail your entire financial future. So the art lies in finding the balance, identifying where risk lives inside your financial strategy, and taking steps to manage it before it manages you. Now, in a year marked with soaring inflation, stubborn interest rates, volatile markets, and global uncertainty, reassessing your portfolio's risk has never been more important. Now, today, we're breaking down 10 key considerations that can help you approach risk with some clarity, confidence. And so if you can increase your chances of long-term success. Now, before we dive in, first, let me bring in my co-host, Tony Shore, who's been testing his own tolerance for risk by drinking gas station coffee every morning this week. If that's not high stakes investing, well, then I don't know what is. Maybe got gas station sushi. There you go.
Ooh, ooh, yikes. No way.
Tony?
Uh, no way. I'll have you know that gas station coffee is a no-go for me.
No go. Okay.
Yeah. Yeah. Yeah, I can't do it. I'm a little too picky. My dad although I did grow up, my dad was a truck driver and I'd go with him sometimes, and when we'd stop at truck stops, he'd drink the truck stop coffee. And then
Right.
as I got older, in my late teens, early 20s, and I'd go out with him,
Yeah.
I got used to the truck stop coffee, but no more. I've been spoiled. I've been too spoiled.
Right.
Um, how have you been? Now, Detroit teams have been doing pretty well, but I
Yeah.
know this is your busy season for work, isn't it?
It is. It is. It really is. All the fun and playing's done in the summer, so everyone wants to, you know, sit down, figure out the rest of the year. A lot of people want to retire during this time of the year for the new year, so this keeps us very busy. But it's a good thing. To get people retired every year. Wow. I mean, what else can you ask for? So
Right. Yeah, yeah, that's true. And but everybody seems to want financial advice and needs help in the fall, right? It's the
mhm,
it's the
mhm.
busiest time for you
It is.
because
It
you've
is.
got Medicare annual enrollment happening. You've
You
got
got
people end of the year planning. We'll probably do a show coming up on, what to get done before the end of the year. We'll talk some more
it.
about that, but taxes, things like that. So I know you're busy, but today we're talking about managing financial risk.
Mhm.
And even though the markets, again, as of this recording, I see the markets, the S&P hit another record high. That's been
Yep.
happening a lot lately.
Yep.
But what goes up must come down. And I know in the future, there's always going to be market volatility, ups and downs. So
Mhm.
it's good to make sure you're managing your risk, especially as you get closer to retirement. Um, and managing real risk in your portfolio is important. So I'm excited to unpack that today.
Yeah. In fact, as a reference point for today's show, we're going to be relying on a recent Kiplinger article titled 10 Strategies for Managing Financial Risk in Market Downturns.
Okay, so what's the first strategy that the article states, or that you would say is important for managing risk?
Yeah, the first thing I would always start with when talking about risk is what we call risk tolerance. And really, that just means how comfortable are you personally with the ups and downs of the market?
Yeah, so it's less about numbers on a spreadsheet and more about, can I actually sleep at night if my account dips? That's what risk tolerance is, right?
Exactly. Because here's the thing, markets go up and down. That's just reality. But if someone can't stomach seeing their portfolio, let's say, drop during a market downturn, well, there's a real risk they'll panic. And when people panic, then they often make rash decisions like pulling money out at the worst possible time. And that can have devastating long term effects here, Tony.
Well, yeah, I would imagine I've seen that happen actually with friends of mine, Albert.
Mhm.
They watch all the headlines, they look at the markets each day, and if it dips, they're suddenly like, I'm out, like April of this year.
Right?
I know people who panicked, and when the markets dipped because of the tariffs in April or at the news of tariffs, and not only would they have been fine if they stayed in, they'd end up much way ahead of the game. So you can't let emotions dictate decisions, right?
Correct. In fact, you know, that's where a thoughtful conversation up front makes all the difference. I encourage clients to spend real time defining their comfort level, basically, with market fluctuations. And we don't just talk in percentages, too, because your account might drop, let's say 10%. Doesn't mean much until you put it in actual dollar terms and actually into your financial plan.
Right. Yeah, exactly. And so I think that's really important. And that hits home. I mean, 10% doesn't feel like anything until you realize, hey, that could be $50,000 disappearing, right?
Yeah,
Yeah.
when you put it in real numbers in front of someone, suddenly it does get real, and
Yeah.
that's what we want, though, because once you know your true comfort zone, then we can build a strategy that keeps you invested for the long term without the panic button getting pushed when things get bumpy.
Yeah. And that means step one is kind of like a gut check to know yourself, know what kind of volatility you can handle, and be honest about it. Right. In fact, you have a color of money risk analysis that people can
Mhm.
take to see what their own risk tolerance is. And that helps you put together a plan for them. Right.
Yes, yes, definitely. In fact, risk tolerance, it's foundational. It's where we build from, but we have to know, what is your appetite? Now, the next piece of the puzzle is something we call risk capacity. And while it sounds similar to tolerance, it's actually very different, Tony.
Yeah. Well, yeah, it is. And so risk tolerance is about how much risk you can stomach emotionally.
Mhm.
It's about asking how much risk you can afford to take.
Yes, you nailed it right there. Someone might feel perfectly comfortable taking big risks, but if their actual situation doesn't give them the cushion to do it, being aggressive could backfire in a big way.
So it's the difference between, hey, I want to bet big, or should I really be betting big with the money I have?
Bullseye. In
Yeah.
fact, imagine a retiree with a modest nest egg. And even if they say, I'm okay with volatility, bring on the risk, it may be unwise to put everything into equities or illiquid real estate. If the market turns against them, then they don't have the time or the resources to rebuild back.
Well, I just think we should be building a nest egg.
Even Marge knows that, Albert.
Yes,
Uh,
yes.
yeah. Because, once you're retired, you're not adding new money, you're drawing down, and there's no reset button. So if things go wrong, that's why you need a plan. You need to work with someone like yourself.
Yeah. Well, now flip the scenario there. A young professional with a strong income, decades ahead of them, and a healthy emergency fund. Now, that person can potentially afford to take more strategic risk because they may have the time and the cash flow to ride out downturns.
Yeah. So capacity is the math behind the feelings, right?
Yes, yes. In fact, that's a great way to put that, Tony. It's about your time horizon, your earnings, and your earning potential, and how much safety net you actually have. If all those numbers line up favorably, then yes, you may be able to safely take on more risk.
Well, and that's it. And if they don't, it's better to acknowledge that and build a strategy around what you can do instead of pushing into risky territory just because you want to, right?
Right. Tolerance is heart, capacity is math. That's how you want to look at it. And both have to work together.
Well, yeah, that's it, and both do need to work together. And speaking of that, how can someone like yourself, a financial services professional, help someone manage that financial risk?
Well, as a let's say financial service professional, my role is to actually help you identify where risk resides first in your financial life, and then measure how much you can truly afford, and then build a strategies that protect against the unexpected. So with guidance, discipline, and perspective, I ensure risk becomes a tool for growth and not a threat to the future.
Yeah. Yeah, that's a great point. Now, we should probably take a moment here, Albert, to let our listeners know how they can get a hold of you to set up that no charge, no obligation consultation. I know you love to hear from our listeners
Mhm.
and viewers out there, maybe answer questions they have. And how can they do that? How can they set that up?
Yeah, folks, you can visit my website at www.kaizenfinancialinc.com, Kaizen, Kaizen, or call my office at 586-752-7008 and discuss how we can answer your questions and address your concerns about managing financial risk, your financial strategy, or any other parts of your retirement.
Yeah, I think that's really great that you offer that. And today's show is a good one. You've been talking about some strategies for managing financial risk. You talked about risk tolerance, risk capacity,
Mhm.
those two things. And I really want to remind listeners that, reach out to a trusted financial services professional. Albert Lalonde is here for you. I know you love to hear from people, Albert. What do you have for us next?
All right. Let's shift some gears here and talk about something called shallow risk. Now, this is the kind of risk people see all the time, the daily ups and downs of the market. One stock might rise, another might fall, and it can feel painful. But the key is it's usually temporary, Tony.
Well, that's good. And so what you're saying is this is like when I check my retirement account and suddenly I'm down a few $1,000s. It's going to sting, but it doesn't necessarily mean I've lost money long term, right?
An excellent point, actually. Yes. Prices can drop sharply and even for, let's say, stay down for a while. But unless you sell, well, those losses aren't locked in. It's not permanent. And the market has historically bounced back, and shallow risk is part of that ride.
Well, yeah, it is. And even knowing that, it's hard not to panic. It's human nature, right? I
Mhm.
mean, if I see red numbers, my gut reaction is, hey, what do I need to do? I've got to do something about it. And a lot of times, for a lot of people, that means they sell because it's one thing they can do, but it's usually the wrong thing.
You're right. That's where preparation really can make a big difference. One strategy that I encourage is keeping sufficient cash as a cushion in your checking or savings account. I like cash. Why? That way, if your portfolio dips, you don't feel forced to sell investments just to cover your day-to-day expenses.
Right. And basically, having some cash on hand, it helps you or keeps you from making emotional decisions when things get rocky, then.
Very true. Very true. And shallow risk is inevitable if you're investing in liquid securities. It's just part of the game. And the key isn't avoiding it, it's managing your reaction so you can ride it out by relying on the strategy you've built with your financial service professional. Now, shallow risk is one thing, it's uncomfortable, but it's usually temporary. What we really have to watch out for, though, is what we call the deep risk. Now,
Mm.
that's the kind of loss where your capital is permanently impaired and it's unlikely you'll recover.
So, yeah, deep risk isn't just watching your account bounce down and then back up again. It's the
Right.
deep risk is the kind of change that hits your financial picture and has long-term lasting effects and could, it hits it for good, right?
Yeah, I mean, as you said, that's a good call. The
Yeah.
article explains that in fact, writer Dr. William Bernstein breaks it down into four categories: inflation, deflation, confiscation, and devastation. So each one represents a different way investors could see lasting damage to their wealth.
It sounds like the names of albums by a metal band.
There you
a
go.
heavy metal band. Devastation, confiscation. They do sound heavy. Walk us through those.
Sure. So let's start with devastation. That's the loss of assets due to something extreme, like let's say war. Confiscation refers to losing wealth through, let's say, government seizure or sudden dramatic increases in taxation. And then obviously deflation is the prolonged fall in asset values, like, well, let's say like Japan experienced for decades. And then there's inflation, which, well, we're all very familiar with that right now, the steady erosion of your purchasing power as prices climb.
Well, and that one hits home. I mean, groceries, gas, everything feels more expensive, and that's the kind of risk you can't just wait out.
Right. Well, here's the good news, though. For many US based investors, inflation is really the only one we need to worry about in a, let's say, practical sense. Deflation tends to be countered by Federal Reserve action. And while no system is perfect, confiscation and devastations are highly unlikely here because of our relative stability we still have.
Yeah. It seems the real everyday battle is inflation, and we all feel that. How do you help your clients fight that?
Well, one approach is to overweight let's say, a diversified portfolio in equities. Historically, stocks have been one of the most reliable ways to actually outpace inflation over the long term. Now, it doesn't eliminate the problem, but it does help preserve and grow purchasing power so your wealth keeps working for you even when prices rise.
Yeah, that makes sense to me. Focus on the risk that's most real in daily life and make sure your portfolio is built to keep pace.
That's the go. Exactly. Acknowledge the possibilities, but concentrate energy on the risks that truly matter for your future. And then another important one to also recognize here is called concentration risk. Yes, this happens when too much of your money ends up tied up to just a handful of investments.
Well, and does that mean instead of spreading things out, it's like putting all your eggs in one basket?
Yes, actually, that's exactly it. In fact, sometimes this happens unintentionally. For example, people who get paid, let's say, heavily in company stock over the years, it can quietly build until it makes up a huge percentage of your portfolio.
Yeah, I've known people where all their retirement savings is in company stock, and
Mhm.
that can become a problem. And other times it is a choice though, like chasing whatever's hot in the market, maybe.
Yes, yes. And in fact, if you imagine during the long bull market, a lot of investors went all in on tech stocks because that growth seemed unstoppable. In fact, I'm still seeing that today. But as the article tells us, when the NASDAQ dropped around 30% over the past year, those who weren't diversified, well, they felt a very painful hit.
Yeah, I mean the Nasdaq took a big hit, and that kind of made some people say, "Ouch." So even though tech had been winning for over a decade, it's still risky to lean too hard in any one direction.
Yes, it is precisely. And that's why proper diversification matters. By spreading your money across different industries, asset classes, and even geographic regions, you minimize the chance that one downturn wipes out too much of your portfolio.
And for me, that means it's not just about chasing what's hot. It's about making sure your portfolio has balance so you can weather the storms in any one area.
Yes, that's a big key there. Diversification doesn't guarantee profits, but it does reduce volatility and helps protect you from being overly exposed when a single sector, or let's say a stock, takes a dive.
Yeah. Well, and this has been a great conversation so far, Albert, about potential strategies for navigating financial risk. You've given us a lot of food for thought so far. What's next?
Well, let's keep going with the Kiplinger article titled 10 Strategies for Managing Financial Risk in Market Downturns. It now addresses liquidity risk. This is the possibility of not being able to sell your investments at the price you want or even at all when you need to.
Yeah. So it's more about timing than it is about market swings.
Yes, I agree. In fact, some investments like private equity, hedge funds, certain types of real estate, even collectibles like, let's say, artwork, can take months to sell. In fact, if an investor suddenly needs cash, well, they may be stuck waiting or forced to sell at a discount.
Mm. That sounds like a nightmare to me. I mean, imagine needing money for an emergency, but all your wealth is tied up in something that you can't unload quickly.
Yes, that's the challenge. And it's not that illiquid investments are bad because they can be, well, value based on valuable parts of a strategy like tax strategies, but they need to be balanced with assets that are also easier to access.
And what does that balance look like?
No, it starts with a solid cash cushion, of course. Like I said before, I like cash. But beyond that, owning liquid investments, like let's say blue chip stocks or high quality bonds, they provide some flexibility. Then they give you the ability to also raise funds without putting yourself in a corner. Now, another key area to consider is credit risk, though. Okay. So this mainly comes into play with the bonds, as I mentioned, if you're going to go in bonds. It's the risk that the government or company issuing the bond won't be able to make interest payments, or in fact, maybe not repay the principal when it's due.
Hmm. So it's like loaning out money and just hoping the borrower pays you back.
Basically, that's it. It's like loaning your money to your children. Okay.
Yeah.
But anyway, bonds are essentially IOUs. If you buy a bond, you're lending money to a government or corporation, and now you're counting on them to make good on their promise.
Okay. So that's good. Now, I know some bonds pay more than others. Is that tied to how risky they are then?
Yes. In fact, lower quality bonds often offer higher returns because they carry a greater chance of default. And it's that classic trade off: higher risk, higher potential reward. But you need to be careful because the downside, well, that's very real.
I imagine it is. So how do investors know what they're getting into then?
Well, there's where what we call bond ratings. That's what comes in to rate the bonds. Now, bonds are graded on a scale with triple A representing the lowest risk. And then on the other hand, bonds rated below double B plus are considered junk bonds. They carry the highest risk of default. And so if you invest there, you need to be prepared for the possibility of losing that money.
Well, and so I guess the lesson here is don't chase yield without understanding the risk behind it then.
Yep, that's exactly right. With credit risk, due diligence is everything. Now, ratings are a great starting point, and making sure your portfolio isn't overloaded with high risk bonds is crucial for long term stability. Another risk that surprises a lot of people, though, is interest rate risk. And we're going to start seeing this. This is the relationship between interest rates and bond prices, they move in opposite directions.
Oh, so they're opposite. So when rates go up, do bond values typically go down then?
Well, we saw this play out in 2022, if you can remember, Tony, when the Federal Reserve raised rates aggressively. What did the market do? Well, the market prices of investment grade bonds, well, they typically considered the safe part of the portfolio. They fell by double digits. In fact, for 22, the average loss in the bonds were 15.5%. And for
Ouch.
many investors, seeing that portion of the portfolio decline so sharply was unsettling.
Yeah, I mean, bonds are supposed to be the calm, steady piece of the puzzle here, and seeing them lose value, I know that threw people off. I know in 2022, usually when the stock market goes down, bond values go up. But in
Yeah.
this case, in 2022, they both dropped significantly, and that's why that was a rough year.
Yes. And, that's why understanding duration is important. Duration is basically a measure of how sensitive a bond is to changes in interest rates. The longer the duration, the more the bond's price will move when rates shift.
Yeah, yeah. That's so. What's a strategy to protect against that then?
Now, one way is first shorten the duration of your bond holdings. If your bonds mature sooner, well, they're less affected by interest rate swings. And then it's like tightening the sail, let's say on a windy day. You have more control and less exposure to what we call the sudden shifts or the sudden winds.
Right, and that makes sense. Shorter duration means less turbulence when rates change.
Yes. And it doesn't eliminate the risk, though, but it does make it more manageable, Tony, and especially in times of rising interest rates. Now, let's talk about horizon risk. That's the next risk. This comes into play when unexpected life events change your investment time frame.
So you're saying something like a job loss
Mm,
or a health issue could suddenly force you to rethink how long your money has to last then.
yes. In
Yeah.
fact, events like disability, death, a major expense, or even losing your job can shift your financial horizon overnight. And what you thought was a 20-year plan could suddenly become only a 5-year plan.
Yeah. That sounds stressful because those are situations that you can't really plan for in detail.
Right. But even though you can't predict them, you can prepare for it. For example, proper insurance, like let's say life, disability, homeowners, and even umbrella coverages can provide protection for many of these events. If the worst happens, those safeguards can prevent a financial free fall.
Yikes. What about something like losing your job? I mean, that's happening, especially to a lot of government employees right now.
Mhm.
That feels harder to cover with insurance.
It is. In fact, it's trickier, but that's where having a robust emergency fund comes in. Again, remember, strong cash reserves buys you time and flexibility. Pair that with the willingness to cut some of your expenses and adjust your lifestyle if necessary. And well, you've got a plan for staying afloat then during those tough times.
Yeah, there you go. And so we should probably wrap up now. But before we go, is there anything else you want to add, Albert?
Folks, if you're really concerned about the risk you're taking, if you want to know what your risk tolerance should be, the color of your money, as well as learn on the rule of 100, visit my website, www.kaizenfinancialinc.com. That's Kaizen, Kaizen, or call my office at 586-752-7008 and we'll discuss how we can answer your questions and address your concerns about managing financial risk, your financial strategy, and any other parts of your retirement. Remember, it's our goal to help you prepare for the retirement you've worked hard for so you can own your retirement.
Awesome. And that's what it's all about, Albert. Thanks for all the great information today. And listeners and viewers, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everybody. Awesome.